Thank you. Well, as Joanna noted, while microfinance 1.0 and 2.0 might have been more focused on the supply side, the current focus is to a much greater extent on the demand side. And that's what we're going to look at in this session. So what financial services do poor consumers need, and for what purpose? What are the gaps in meeting those needs? We'll look at a range of issues around demand, financial capability, and around impact on clients. So Candace, do you want to start us off with a few remarks? I'll have a few questions, and then I'll open it to you for additional questions.
Thank you, Susan. So with the demand side of microfinance encompassing billions of people in hundreds of contexts, it's a little bit presumptuous to think that we can address it in 30 minutes. And yet demand, the needs of poor consumers, is really the raison d'etre of microfinance. And it is, thankfully, the subject of renewed industry focus in version 3.0.
Where's Bob?
Is it on?
Popular.
Okay, there we go. So the way the book frames understanding demand goes well beyond traditional market research, which seeks to identify what people need and what will sell. We have acknowledged that there's a multiplicity of needs, and yes, there is a plethora of providers surfacing to meet those needs, and yet persistent barriers prevent consumers from really using all these new products. So to further the goal of financial inclusion requires a deeper and more nuanced understanding of potential clients and the factors that influence their financial decisions. Today, we will explore a few of those issues that we need to address on the demand side. We will talk about products because they link consumers and providers. How have they changed, and what common features, if any, do the most attractive products share? What's on the horizon? And where are the next breakthroughs? And we'll talk about impact. We understand better now that the benefit of access to finance is not a direct causal line to poverty alleviation. In fact, impact is mediated by the ways in which people make their financial decisions and by how the products that they use interface with social dynamics, be it religion, age, gender, to name a few, that guide their lives. So we need to understand much more about that. I remember earlier times when repeat loans were proposed as a valid proxy for impact, and I think, thankfully, we've moved beyond that. And a new theme that shapes our thinking about demand is consumer education, both to increase financial literacy and to strengthen consumer protection. As much as financial inclusion requires a diversity of products and a diversity of providers, it also requires knowledgeable consumers who are able to choose products that best meet their needs and use them effectively. And I find myself using this phrase, choose and use, quite often when I talk about financial capability as a cornerstone of financial inclusion. So those are, I think, three of the major issues we're going to touch on today. I was going to say something about the informal sector, but the previous panel completely covered that topic as far as I'm concerned, although I think there is still a question on the table as to whether we can count those who are active in the informal sector as being financially included. And I want to keep that question alive as we go through the rest of the day. So, thank you, Susan.
Choose and use, a great expression for us to keep in mind. So, Candace, why is financial capability surfaced as such an important component and aspect of financial inclusion?
Well, if you go back to version 1, or maybe even 2, when microfinance was characterized by a single product offered by a single institution, the assumption that if you build it, they will come was perhaps valid at that time. But today, microfinance is characterized by technology-driven innovation, many more providers, and increased competition. And in that context, I think consumers don't always have the knowledge and the skills, and particularly the confidence that they need to compare products and select products and obviously compare institutions. They are vulnerable to aggressive marketing and misleading information. And on the flip side, informed consumers make better clients, as somebody in the previous panel said. They're able to put pressure on the marketplace for appropriately priced and transparent products and services, and knowing their rights and responsibilities. Informed consumers can also participate in their own consumer protection.
You raised the question of impact, which I'm now looking at Anne. how has impact come into this debate, and what have we learned about the impact on clients? Can you lead us through some of that thinking?
Well, that's already been talked a lot about leading up to this discussion, but I think what's interesting is how the discussion around impact has changed, at least as long as I've been involved in this world of microfinance. In the early days, we thought that social performance measurement might be enough to really track how credit was having an impact on people's lives. But then that metric or way of thinking about impact changed and became a little bit more rigorous. And I think the discussion I was just having with two people at lunch was really interesting, because when you look at what exists out there now in microfinance in terms of our evidence, or what is available to better understand what the impact of microfinance, both savings and credit, insurance, even the opportunity to affect wire transfers, how is that actually translating into better livelihoods, better cash flow management, et cetera. And I thought Rich Rosenberg's comment in the Portfolios of the Poor was so eloquent. That comment around when he asked that woman, how has microcredit made a difference in your life? And she said, what are you kidding? I can now eat every day. So that probably it's a wonderful commentary and anecdote, but we need to put more rigor around it. And I think what the book helps introduce us to, Chapter 5, it really takes us through what research methods are now available. And I went back and I looked at them. There are 5 different research methods, and they're really nicely described in the book. There are now 7 poverty assessment tools. Depending on who you're trying to describe the impact to, you have a range of ways of selecting your measurements, your methodology, as well as your research method. And that's a really interesting development, I would say, in the last 10 to 15 years that is really helping, I think, generally the industry. Our friends at CGAP are in the process now of organizing a really good resource, soon to be available, right, Steve, at some point, which it summarizes all the impact studies that are out there, so that you no longer have to go searching the web to find out who did the most recent impact study on village savings groups in Kenya, okay? There's a really nice database that's coming together that compiles all these studies. And that's going to help all of us. It'll help all of us better understand how you look, for example, at client segmentation, how you look at product development, and even how you look at impact. And believe it or not, the actual number of impact studies still that are available to us, take a guess. How many do you think there are out there? More than 10? Do I have a yes? Oh, someone's going like this.
Yes,
we actually have less than 20. So when you think of the amount of money that has gone into serving the needs of the poor, the financial needs of the poor, we do have work to be done, a lot of work ahead of us. So I do think if you take time to look at Chapter 5, it starts to set the roadmap of how we can do more around this really important area of work around impact. So I've made my case.
And linking that impact with diversity, we've talked earlier about how the understanding of the diversity and the range of products out there is such a significant recognition. Joyce, can you say something about how the industry has worked to meet and match the needs of consumers and products, and where are we in that?
Microfinance was really about microcredit. I mean, let's face it. And I think in the minds of a lot of people, that's still where it is. I was fortunate enough to work in a donor organization that and made a strategic priority to say, we really want to move beyond credit. We want people to recognize that poor people need a Can you hear me? That poor people need a safe place to save as much as they need a loan and more. So how do we do that, and who do we work with? Well, first of all, clearly when you get into taking voluntary deposits, now you're in the regulatory environment. So that really limited and was somewhat revealing in terms of recognizing the number of microfinance institutions that were regulated and had the ability to collect voluntary savings, but really weren't doing it. You know, they hadn't figured it out. And so what was the barrier there? What was the challenge? And the more we worked with some of these institutions, there's a number of things. First of all, it's really different. It's a real culture change within the organization. When you're offering credit, it's not very hard to get people to come to you. You know, people will walk kilometers, miles to get a loan, and possibly even to repay the loan because they know there may be a larger loan coming after. People aren't going to make that effort to deposit small amounts into a savings account. They're just not. And it doesn't make sense for them. It probably doesn't make sense for the institution. So the whole effort to provide this additional product, specifically savings in this case, and there are others, really also brought to the fore almost immediately the need for an alternative delivery channels so that we could get to the place where people were, and the attempt to get the financial services at their doorstep. So that brought in sort of the whole other factor. But the challenges, for example, to provide savings really is that it does involve a change in the corporate culture. When you offer credit, you have to trust the clients. When you offer savings, the clients need to trust you, because they have had other mechanisms for keeping their money safe, whether it's in the rice bin or whatever. Now they have to trust this organization, and that creates a different dynamic. It's a different skill set among the staff. Someone who's really good at being a loan officer may or may not be a good savings person to encourage their clients to save. So it's really a huge difference, and that has been part of the challenge. The good news is that there are more and more that are doing it. Now, some microfinance institutions, many of the larger banks, they do take savings, but in many cases they take large institutional savings while they're still serving sort of the micro population with lending. And in one or two cases, some of these organizations we started to work with said, look, we want you to offer savings, but we want you to offer it, you know, to the low income people with low balance accounts and small transactions. They kind of like, no, you know, it's not, there's no business case for it. We don't even want to go there. You know, so it's pretty interesting. Insurance, Kate talked about some of the requirements in insurance. It's highly regulated. Obviously, certain providers able to. It's really hard. It's really hard in the U.S. It's hard for people to buy health insurance if they don't absolutely have to. It's hard, as we all know. Car insurance, if it wasn't required, probably only half the people would do it. Funeral insurance may be an exception because everybody knows that is something that someday they will use. But it's very hard to get people to buy something that they may or may not have a use for. Thank you. We are moving toward considering the ability to make payments as a product. You know, that payments that ability is also a product. In many cases, it may be connected to a bank account, but it may not. You know, it may be connected to an e-wallet on your phone. So those are some of the uses. Clearly, there's a demand for it, but it's a challenge figuring out how to do it.
I have lots more questions, but I'm sure you do as well. So let's open it. I'll take a couple of questions at a time. Again, please remember to hit the microphone and to very briefly introduce yourself.
Susan, your question about matching demand with products and the challenge of operating costs has come up a few times today. Have financial institutions really done all they can to reduce operating costs, or are there areas of research where we can improve this?
Okay. So a question I'll get you to think about while I take the second one is whether financial institutions have done all they could to reduce operating costs to be serious players. Yes.
One of the issues to me...
And please introduce yourself briefly.
Okay, John Anderson. One of the issues which, working for the Canadian Centre for Policy Alternatives, one of the issues which I think is important when we're looking about what financial services low-income people want is the question of participation and control in the financial institutions. And I haven't heard a lot of discussion around that issue. Certainly, to me, when you're talking about, that's why I think credit unions are an important vehicle. But I also think that whether that's postal banking or other state banking services, which we have both of those in Canada, a lot of those. We have a lot of credit unions, and we have the biggest state-owned bank is in Alberta, which is owned by the provincial government. So I was wondering, to what extent should we be looking at these issues about how people can participate in the financial services which they're receiving, and how they can begin to control the institutions which are giving them those financial services.
Okay, so one question about operating costs and the other about participation and control.
Well, I can certainly, I think I've got your mic and my mic together. Okay. I can certainly talk a little bit about a form of community-based financial service provision where there's total control of the members. And those are savings groups that have grown exponentially in Africa in the last 20 years, I'd say. And these are facilitated informal institutions that exist at the village level, and they are owned and controlled by the members. They receive no outside capital. The savings and lending is all driven by member savings. Members decide how much they will save every week or every month. They decide what the interest rate is on the loans that they give, that they use their savings to give loans. They decide the interest rate, they decide loan term, they decide all of the policies regarding savings and lending, and they are in complete control. And the role of the external facilitator who teaches this model is to never touch the money, never give any extra money, and never touch the money, but just teach people in the group how to manage that money. So that's an informal mechanism, but it's a facilitated informal mechanism. And my friend Joanna is holding up a publication that's just come out from Aga Khan that describes this generically what's known as savings groups, but in the Aga Khan universe, they're known as community-based savings groups.
I don't know that this is an opposing view necessarily. I certainly agree with what you're saying, and I think that makes sense in a community-based or a village-based. When you get to an institutional level, I'm not sure that's the first priority for a poor person. I think they want to make sure that the services offered by that institution are useful. I mean, my bank, I want it to provide service. I don't really care if I own the bank or not. Obviously, I want it to provide the services that I need. So I don't know in general whether that's it's an opinion, not a fact, whether that's a high priority for poor people, that they own or have an input into the management of the financial institution or the operations. I may be wrong. What do you think?
I was actually going to move back to the first question on operating costs, which I do think, I know that the work the foundation is supporting is we're constantly exploring which models will achieve more scale, reach more people, but also at an effective and efficient level, and thereby contribute to their sustainability. So Ruth was speaking earlier. We do support some institutions, but we are looking at broader ways to examine this issue. Technology, clearly, and the panel that talks about technology is certainly one of the areas of work that everyone's very focused on as one possibility, one way of bringing down delivery costs as one option.
Thank you. A reminder to make sure that we understand assumptions and not or needs and not impose our own assumptions. Other questions?
Are the answers to what kind of services are needed? Is it globally applicable? Can you divide things regionally? nationally? I mean, do you see consistency no matter where you look in which services are needed and what type of service, or does it vary widely depending on country?
Did everyone hear that? So the question is around what kind of consistency is there across countries and jurisdictions, or is there great variation? Is that a fair assessment? Go ahead.
Well, one thing I was going to say is I think it's Findex that's done a great job, which is a new initiative, well, not so new perhaps, it's come out of the World Bank together with Gates funding to support mapping the demand side at household levels, right, and also probably more formal financial services. There's a lot, we recognize there's a lot more to understand and to go. And also to map that against what's being supplied. So I think efforts are underway to really understand and map the needs of clients, but we all recognize there's a lot more work to be done there.
And there's probably variation within a region as well. You know, I think it would be tough to say that this country needs more of this and the other country needs more of something else. But Bob?
Bob has his hand up.
Yeah.
It just struck me that people in the audience may not be so clear as to what we mean when we talk about payment services. What the poor in payments? What is that all about? Maybe it would be helpful to spend just a minute saying,
sure,
what is this conversation about payment services, just for the audience?
Okay,
good point. Thank you.
Clarification.
We all make payments. We deal, but poor people who also, whether it's a shopkeeper paying a vendor, whether it's someone sending a remittance, they have to make a payment from one person to another. Right now, it is limited and time-consuming and expensive for people because they operate in cash. So if you have to pay a utility bill, you have to go and stand in line and pay it in cash. With remittances, you have to either deliver yourself, pay someone else to do it. When we talk about payments, it's essentially the ability to make those digitally instead of in cash. And so that kind of involves this whole technological ecosystem he was talking about with M-Pesa in Kenya, where they have, is it 20,000 plus agents, small agents around the country, where you can go, you know, in your village or down the street with your cash and have that converted into electronic money on a device that you can then send to someone else. So it saves time, it's convenient, and all of that. But it's something, having the ability to make a digital payment, I would say, is what we're talking about.
And that in turn will bring down costs. Yeah.
And will bring down costs.
Yep.
Thank you for the presentations. My name is Nicole Pasricha from MEDA, and I just wanted to go back to one of the comments. I think it was Joyce. You were mentioning the big difference between offering savings and credit and the type of trust and the impression that the customer needs to have of the institution. So given this shift on the demand side for, I don't know if they're more sophisticated products like savings and insurance where there is this level of trust that needs to be and brand maybe at the institutional or the service provider level, do any of you see a shift in the role of MFIs going forward in the sense that perhaps they will become more like a broker of a service that was mentioned in the previous panel, or they would become more like service companies operating on behalf of other more sophisticated financial institutions in the background that provide that level of sophisticated service?
There are cases that I know of where that has worked, where an unregulated MFI that wants to provide savings services to their clients may collect savings and assist the client in opening an account, you know, in a regulated bank, and then facilitate the collection of savings and deposits on behalf of their clients. So I think that has worked, and I think it can work. I think, again, the issue is, you know, getting to scale, having it be a product that's useful for the client. I still think there's a real role for these service providers just in terms of some of the education. You know, do they have the ID they need? Do they have, you know, the ability to fill out an application form, you know, to get a bank account? So there is still a role for them to play, even though that that particular organization may not be able to provide the full service. So I think there can be a useful connection role.
I think we've seen the same thing with insurance as well, that the traditional insurance broker role will become stronger as insurers figure out how to insure really poor people.
Any last thoughts? Any of you want to add very briefly?
Well, I would just like to say that we have touched on the formal and the informal, and we have said that poor people and their needs are met by both, and that the poor move back and forth. I think there's an assumption out there that the poor like the informal sector because it is familiar and because it is based on relationships of trust. That is a wide assumption. And what I want to say is that what poor people need is a moving target, and it's dynamic, and it is ever-changing, and technology will change that. And the example that I want to bring up is savings groups in Kenya. When I was visiting them, I was asking women where they put their money that they didn't put in the savings group, because a savings group deposit is a long-term deposit. And I said, where do you put your money when it's short-term, when you want to hold it for a month or a week? And to a woman, they all said, M-Pesa. Oh, Madame, M-Pesa. And I said, oh, come on, there's got to be money under this rug. There's got to be money hidden in this bookshelf. There's got to be money in your mattress. Oh, no, Madame, it's all in M-Pesa. So the assumption that poor people are in the informal sector because they trust it, to me, is in that example, was blown out of the water in that moment, because all of these women, including the 80-year-old grannies, were entrusting their savings to their cell phone. No person, no face-to-face, no anything. So that anecdote is just to say that I think we are in a very dynamic and evolving context where what we know they need today will not be the same as what they need tomorrow, or how that need is met tomorrow will not be the same.
But I would just say, I think the slide that Joanna showed in her presentation that scopes, at least for sub-Saharan Africa, the range of who are actually included and banked by formal institutions relative to those who aren't, we do still have a long way to go to either bring that closer to, 50%, or even achieve more than 50%. And I think there is a hope that technology will help leapfrog that, but I think we'll have an interesting debate. This sets up a nice debate that follows very soon around whether or not that will be one of the huge enablers or facilitators to help bridge that gap. And just one last point. Again, Joanna touched on it lightly. There's a huge population of the poor that are still, they're smallholder farmers. They're living in rural and remote areas. They will not necessarily be touched, at least immediately, or let's say in the next 2 to 3 years, by banks. So our challenge ahead is how to continue to bridge that gap and do it effectively.
Thank you. Well, we're out of time for this, but I think we've taken several lessons away that we need to refocus as well on the demand side as we have on the supply, that there's still lots of missing pieces of knowledge, whether it's around impact or variations in demand, and the potential for technology, which will take us into some of our other sessions. So thank you all. Thank you.
Thank you.